Mean Reversion Trading by the Equity Management Academy. Mean Reversion Trading Weekly Review. Summary. We have a mixed market while cryptocurrencies are active. 1 week the data shows a decline in economic activity and employment. Another week inflation is up. The dollar continues to decline in value as we print more stimulus, so Bitcoin and other crypto assets continue to rise. Fundamentals. We have a mixed market while cryptocurrencies are active. Bitcoin made a new high of 60,985, trading last at 60,520. Gold is down about $27, and silver is also down on some mixed economic numbers. 1 week the data shows a decline in economic activity and employment. Another week inflation is up. It's kind of a meat grinder, I said. The sentiment of the market appears to be that we are moving forward toward a weaker dollar, which is why Bitcoin is becoming such an in-demand asset. The dollar continues to decline in value as we print more stimulus, so Bitcoin and other crypto assets continue to rise. We use technical analysis in the form of our proprietary AI algorithm, the Variable Changing Price Momentum Indicator, VCPMI, to analyze and trade the markets. The VCPMI provides precise entry and exit points and acts like a GPS for your trading. In our weekly gold report, Nikki the Robot said that the weekly trend momentum of 1778 is bearish, while the weekly price momentum of 1762 is also bearish. A close above 1762 stop will negate this bearishness to neutral. If short, take profits at the buy 1 level of 1741 and the buy 2 level of 1725. If you are long, take profits at the sell 1 level of 1778 and the sell 2 level of 1799. The buy levels are also where you would want to enter the market long, and sell levels are where you would want to enter the market and go short. Gold came down into the weekly average price of 1762. It reverted from there after completing the target from the previous signal of 1778. It reverted up by activating a bullish price momentum. The daily and weekly signals almost match, so it became a stronger signal. The first weekly target was completed, and then the second target of 1799 was completed. Now we're looking for a short trigger, which the market activated on the 14th at 1796. The level below is the first target. The market made a low of 1765. Buyers then came into the market. In the longer-term picture, the market has come down to a 50% Fibonacci retracement from the high of 1919 in September. We are in a major uptrend channel, short-term. We are beginning to establish the bottom of a third wave within a bigger bullish wave pattern from the low of March 2020 to August high of 2089. That was the first leg. The second leg is being completed now. It has been in this pattern for a year now, in the midst of a 5-wave lag pattern. We are beginning the third wave now with a target of 1963 to 1937 was 23.6% Fibonacci retracement. The monthly average is 1772. The market hit 2129 in August 2020. Then the market came down as supply came into the market. The decline stopped in March 2021 from the monthly level, and the market reverted back up. If gold closes above 1844, it would activate a yearly price momentum. Closing above 1772 activates a monthly bullish price momentum. The target of 1788 is active for the rest of the month. The market appears to be reverting back above the weekly average, which is bullish. The weekly target is 1778. If we get above 1840, it will establish a major breakout in gold. Or if we come back down to 1740 or 1750, It would be an area to aggressively accumulate. It is probably a couple more weeks until the final bottom is in, or we could make the annual low, unless it's already in place. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes. I'm sorry that I missed that, but as I was saying, the system is going through a period of recalibration, And what we're looking for is the final confirmation for this seasonal pattern to begin to continue in the metals, uh, due to the fact that one of the things that I have been experiencing, and I'm sure that if you've been trading in the gold market here for the past year or so, it's been very frustrating. The fundamentals are one of the most bullish fundamentals since the 70s. The price of crude oil is going towards $100 a barrel again. It's at $82 a barrel. We have a shortage of energy in Europe. Natural gas is going through the roof. And we're moving into a winter where demand usually is higher for energy. So the fundamentals are still unclear in terms of the direction of the market, or what direction the market should have in here. One of the things that I'm doing here is I am preparing to aggressively get long. I am long, and I recommend all my traders in my private trading room to be patient and continue to add to your long-term position any chance that we get when we get this spoofing, what I call, of sellers that come into the market and supply the market with an incredible amount of supply that's not even realistically to be able to deliver physically. And this is what's been going on, since 2012, when they eliminated the uptick rule, where essentially it gave algorithms the ability to continue to pound the market without the ability of the buyer to get out of the position. Or if it gets out, it's at a huge, tremendous gap. And it's been a product of selling supplies 10 times the world supply in the actual physical market sometimes. And they've been allowed to do. They have continued this policy since 2012. And now that Basel III is ending as of January 1st, where these short sellers cannot leverage their physical anymore, called unallocated physical. Now the requirements are that they have to put up as much cash as the physical requires. So financial restrictions or financial requirements are changing for the banks, and they still have what I call a massive short position that I believe has about only 12 weeks left for the market to cover this short position. So I do expect that, besides the seasonality of the market that usually makes some kind of a bottom in a seasonal bottom, not only a seasonal bottom on September 28th, but a yearly low as we move into the end of this year. Now, the question is whether we already have seen that low on September 29th. I'm sorry, September 29, actually. If we take a look at we're looking at September 29, the market reverted, and we published this information in Seeking Alpha on the Associated Press. We alerted our traders in our private trading room that we were expecting a bottom, a seasonal bottom to be completed. And so far, what looks to be the case, we are making a bottom in the market. Even though we got hit pretty hard last week on just the fear that interest rates are going to go up, the market in gold reverted down into the level that you see here, which is below the average price. I think one of the fears that the gold market or gold bulls have, or young bulls, I would say, have, is that if interest rates go up, it's not good for the gold market. And obviously, if you interpret that across the board, an increase in interest rates represent an increase in financing costs for just about everything, for gold leasing, for financing, for leveraging. And so it does put pressure on the leverage factor that's in the market right now, which I think is pretty much at extreme levels. We have a tremendous amount of money available in the market. The market is filled with dollars, and part of the problem is that we're not seeing that money going into the economy. People are not aggressively looking for work. They're not aggressively looking to go back to the old jobs. And there is still some fears of the potential increase in infections due to the variant that we may be unfolding here as we move into the wintertime. But yet we have seen through it all since last year an explosion in commodity prices. Crude oil, as I said, is near $82 a barrel, 83, and looks like 100 is right around the corner. And that is a tax for the economy, particularly coming into holiday time. So we are into a period where we have record demand in the hospitality area, restaurants, food services. They have a labor shortage. And, on top of all of this, we're beginning to feel wage pressure building up. And, the government increased the Social Security 5.6%, I believe. And so even the government is adjusting for inflation. And I think it's just a matter of time before the markets begin to realize that in order for them to stay in business, they're going to have to adjust the increase of costs and pass it on to the consumer, more than we have already seen. So one of the things that I expect is that inflation is going to accelerate faster from here, more than we have ever seen. And in that sense, the rise in interest rates is irrelevant to the gold market, because what will translate to the metals markets, as it does historically and throughout the 70s, that inflation is very bullish for the gold market, even though they may raise interest rates. If we look back in the 70s, right after 1971, we began to see an acceleration of inflation as a consequence of Nixon lifting the gold standard. But inflation was being built in prior to 1971, around 1967, 1968. It accelerated from 1971, and the price of gold basically went from, $35 an ounce to $850, relatively speaking, at the time, even though interest rates went up from the 70s to the 80s to 14, 15% by 1981. And all through that time, gold exploded from roughly about $175 to what we saw, $850 in 1981. At the same time that interest rates were trading at 14, 15%. And so Volcker came in, obviously, and changed everything with Reagan. And rates began to decline, and the price of gold obviously collapsed. But the percentage of the market, the move, percentage-wise, was incredible, corresponding to the increase in interest rates. It is a perfect example of an inflationary cycle, basically, that has shifted the consensus, you might say, or the sentiment of the market in gold from a commodity to a monetary unit. This is one of the, I would say, flexibilities that one has in trading in the gold market, that it's not just a commodity that you buy, simply to protect your purchasing power, to protect your wealth, basically, against fiat currency devaluations or implosions. If we take a look at the price of gold, in the price of the US dollar since 1971, the gold has collapsed about 98% to gold since. And we are coming to the end of this 40-year cycle, basically, that is indicating, just based on the fundamentals of the dollar, when you take a look at the debt, just looking at the US dollar as the world's reserve currency, I think that it's very difficult to command leadership, you might say, with such a balance sheet and debt. But it's not just here in the U.S., it's globally, So let me come back here for a minute, and I've been kind of ranting more than anything else about the fact that expect inflation to accelerate. Inflation is not transitory. What we're going to see moving forward is corporations adjusting to this new value across the board and pass that to consumers, basically. And so unless we can resolve a lot of these individual issues, the bottlenecks, the supply chain, the labor shortage, right away, this is going to take some time to unfold. And so I continue to trade in precious metals, in gold and silver. I continue to buy physical, take delivery of the physical whenever I can, whenever the opportunity arises, such as it did last week. I think you'll find that even if it's a small percentage of your net worth, it's going to make up and compensate for this tremendous loss of purchasing power that we have. That essentially is being reflected in Bitcoin, it's being reflected in digital currencies, and that's pretty much one of the reasons that those sectors are thriving, is that people are looking for alternatives away from the US dollar, and they still consider the gold market, as being part of the system. They consider the gold market being, centralized asset. And for all intents and purposes, central banks are buying gold aggressively for a particular reason. Through thousands of years, whenever there has been monetary crisis, the collapse of an empire, the change of a currency system, the price of gold has come through. And so I continue to say, even though gold is not yet, you might say, reflecting the increase of this inflationary pressure across the board in other assets, other commodities, it's just a matter of time before we see the adjustment to the mean unfold. And if you're not in this market, you're going to miss it. Be patient. The time is coming. I think it's just, in terms of the work that we do, just a matter of time. Let me take a look here for a minute on the latest weekly report that we published for the gold market here. And the last few minutes, I want to share this report.
Hello everyone, this is Equity Management Academy with a weekly gold report for October 15, 2021. Summary. The weekly trend momentum of 1778 is bearish. The weekly VCPMI of 1773 is bearish price momentum. A close above 1773 stop negates this bullishness neutral. If short, take profits 1745 to 1721. Trading instructions. Weekly trend momentum, 1778 bearish. The gold futures contract closed at 1768. The market closing below the 9-day SMA 1778 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Strategy. We are coming in with a weekly bearish sentiment unless it closes above 1778. Weekly price momentum, 1773, bearish. With the market closing below the VC weekly price momentum indicator at 1773, is confirmation that the price momentum is bearish. A close above the VC weekly, it would trigger weekly stops and negate the bearish trend to neutral. Strategy. We are coming in this week with a bearish price momentum unless it closes above 1773. Weekly price indicator. Exit, longs. Sell 1, 1797. Sell 2, 1825. Exit, shorts. Buy 1, 1745. Buy 2, 1721. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1745 to 1721 and go long on a weekly reversal stop. If long, use the 1721 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1797 to 1825 during the week. Strategy. Bearish targets are 1745 to 1721 to cover shorts and look for support. Look for reversions from here to unfold back to the mean. A close above 1773 activates the 1797 to 1825 levels of resistance and targets.
Continue to maintain your long position, my friends, and have a great trading day. Until next time, take care, be well, be safe.